Kathy Jones joins us today. She is the Managing Director and Chief Fixed Income Strategist at Charles Schwab, and she'll be giving us her outlook for Fed monetary policy, economic growth, and how monetary policy may affect fixed income products and interest rates. Welcome to the show, Kathy. Good to see you. Thanks for joining us.
Thanks for having me, David. Happy to be here.
Let's start with talking about what the Fed may do next. Well, before we talk about the Fed itself, let's take a look at what's been going on with the 10-year break-even yield. Let's take a look at my screen here. Over the past month and a half or so, it seems to me, just looking at this chart, that inflation expectations have been picking up since their summer lows. Is that an accurate reading for you, that people are expecting higher inflation in the markets?
Yeah, I think the rise in the break evens probably reflects just a more robust economy than we've had. So not, and you look at the overall level there, it's not particularly high. We're in the low twos.
Yeah.
But what we've seen is just a big pickup in economic growth relative to expectations. So if you look at any of those surprise indices, the Bloomberg Economic Surprise Index, the Citi Economic Surprise Index, starting in about mid-September, the numbers just came in above expectations. And I think what the market's doing is adjusting to the idea that economic growth is not going to slow down as much as we thought it was. A couple of months ago, the economy's been much more resilient, and that means the Fed can't cut rates as much, and that means probably inflation doesn't drift down as much as had been anticipated. So you kind of roll all those things together, and I think the root cause is really, particularly in the labor market, those upward adjustments we saw in the September labor report said, oh, the economy is actually chugging along at a pretty healthy rate.
Yeah, so what you're saying is it's not that people are expecting, or the markets are expecting much higher inflation. It's just not coming down as much anymore. 2.4% was the latest annual reading. Is that going to stabilize around that level, you think?
Yeah, I think it'll bounce around in the low to mid twos. Trajectory overall is still somewhat lower. So if you look at 3-month rate of change, 6-month rate of change, it is heading down. But we have certain categories that just persistently are keeping it higher, things like insurance costs, and those don't look to be going down. And then the housing costs, which are still kind of very difficult to get down to where they need to be to get that 2% or below target. But 2 to 2.5% inflation, I think that's acceptable from most of the Fed.
Third quarter GDP numbers came out. U.S. GDP rose at 2.8%. Was that in line with your expectations, Kathy?
Yeah, it was. And the underlying driver continues to be consumer spending, which isn't too surprising. If people have jobs, they tend to spend money. Real income has been rising. Income after inflation's been moving higher. And people don't seem to be real nervous about losing their jobs. We've seen some layoffs, but not those kind of mass layoffs that make people super cautious about spending. So with that driving 70% of the economy, it's not too surprising we're seeing growth hovering in the close to 3% area on an annualized rate, and we expect that to continue.
Retail sales in September came in much stronger than expected. Was that just seasonal, though, people going back to school, spending for their kids, or was that the start of a stronger trend, you think?
It's always tough to judge 1 month's numbers, particularly things like retail sales, which can jump around fairly frequently and be revised. So I'm not reading too much into it. We do see amongst retailers some caution among lower income folks who are getting more careful about where they shop, and even middle and higher income folks. So I wouldn't be too focused on the retail sales numbers. But again, overall, what we're seeing is consumer spending remains healthy. I'm not looking for an acceleration, but a pretty solid rate of growth going forward.
The direction of the unemployment rate. The unemployment rate has been falling for, I think, 3 months in a row now, coming down from its summer highs. What's the trend outlook for you there?
Yeah, it has started to tick up a little bit, and I think that is kind of returning to normal. So we got very, very low in the unemployment rate, really very full employment in the mid threes. And now we're hovering right around 4%-ish, give or take. And that, I think, is, again, probably close to full employment as well. So what we're seeing in the labor market is simply, steady growth in jobs, more than we had anticipated at this point in the cycle. And jobless claims continue to stay fairly low, which tells us we're not seeing a huge amount of layoffs. And it's slowed down. The pace has slowed down a bit, but the labor market still looks healthy. So we think that we could see it tick up a bit, the unemployment rate, but we're not looking for it to really accelerate to the upside or to accelerate to the downside.
You mentioned that people in the labor force overall are not so worried about losing their job right now. I'll just present to you a few data points for you to take a look at here. This is the quits rate, the total non-farm quits rate from the St. Louis Fed. It's been trending down. When people are less inclined to quit, does that not signal less confidence in finding a better job?
Yeah, I would say though, we came off of really high levels there,
Mm.
and now we're back to sort of pre-COVID type of levels where we're probably holding in what I would call a more normal range for the quits rate. But I would agree it's a cautionary sign that perhaps people are less confident about their jobs, but we're just not seeing this kind of widespread fear translate into consumers pulling back in terms of their activity.
How would you evaluate wage growth overall? I saw today earlier this morning a chart showing that the gap between wage growth if the employee leaves and finds a better job versus just staying at that job, that gap widened in 2021, 2022, but has since narrowed. Does that signal a deterioration in labor strength, Kathy?
Yeah, I think it's more of a normalization. That gap really widened because we had such a labor shortage coming out of the pandemic that gap widened. It was a huge incentive for people to change jobs and to move around, and we saw a huge amount of that happen. That's probably not sustainable over time to run with a labor shortage for years on end. And the good news is a lot of people came into the labor force because those opportunities presented themselves. So again, at this point, it looks like, yeah, it's slowing down, but it doesn't look like it's at the point of real deterioration or that we're getting a significantly softer labor market. Could be 6 months, 12 months down the road. We'll have to see. But right now, a fair amount of resilience in the labor market.
Do you think you know who will win the presidential election? With today's sponsor, Kalshi, the only federally approved platform in the U.S. where you can legally bet on election outcomes, you can put that knowledge to work. Kalshi offers markets on major questions from who will win the presidency to which party will control the House and Senate, and even which swing states will flip in 2024. The odds as of October 28th favor Trump at 60% and Kamala at 40%. These odds are updated daily, so check frequently. If you choose the winning side, you could almost double your money. Hundreds of thousands of people are already using Kalshi, and over $1 billion in trades have been facilitated so far. Ready to trade? Use my link in the description down below or scan the QR code here. The first 500 people who sign up and deposit $100 will receive a free $20 credit to start trading on Kalshi today. You probably heard this next question a million times, but I ask it anyway. The advent of artificial intelligence, AI, would that create a widening of structural unemployment?
We don't think so. I think it's early in the game to know the answer to that. But like all new technologies, it shifts things around. But I've been in this business for 4 decades now, and I've heard the death of labor, how I was going to be able to sit at home and not have to work every decade for one reason or another, and it hasn't materialized. So I'd say structural changes, sure, some jobs are going to be much more affected than others probably, but this is a gradual process, and new jobs will be created as old jobs disappear. So I'm not really looking for a decline in the level of employment due to AI.
The argument that new technology is going to make our economy overall deflationary, especially for the tech side. Do you agree with that?
I think there's deflationary pressure that comes from the tech side. We've seen that in the past in these cycles, and we certainly could see it again. I don't know that it reduces inflation or leads to widespread deflation, but in segments of the tech area, sure, I think some deflation would be normal and something that we'd expect to see.
Do you expect crude oil to spike violently upwards on the back of geopolitical tensions? That could be a risk for temporarily high inflation. Is that a concern for you?
Well, it's on the radar, but so far we've had this conflict now in the Middle East for well over a year, and it hasn't happened. And we are seeing slower demand for fossil fuels writ large for crude oil generally, and enough supply coming from other areas. It's also on the radar, but I wouldn't say it's a high probability.
So going back to the Federal Reserve, how many rate cuts would be your base case for 2025?
For 2025. So we're looking for one more in 2024. And then we're looking for the Fed to get down to about 3 to 3.5 for a terminal rate on the Fed funds, and a sort of a every other meeting process between now and the end of 2025.
What would happen in the economy to derail that forecast? In other words, for them to cut more aggressively?
Yeah, if we were to tip into recession or get significantly slower growth, whatever the cause of that would be, I think the Fed would move more aggressively. We still have positive real rates pretty much across the yield curve, where it's 5% upper bound in the Fed funds rate and 2.25%, say, inflation. I mean, there's lots of room to reduce real rates if the economy were to sink into recession or slow down substantially. And I really think if the labor market deteriorated markedly, the Fed would move more quickly. Right now, the labor market holding up, I think their inclination will be to move more slowly.
What about other central banks? If other central banks decide to stimulate more aggressively, like the Bank of China, for example, that recently launched their stimulus package, if the Bank of England cuts more aggressively, or the Bank of Canada, for example, will that influence the Fed at all?
I don't think so. I think the Fed wants, typically the major central banks will move together in most cycles at some stage of the game, but they don't have to move at the same pace. If the Bank of England cuts aggressively, that would be very surprising to me, because their bond yields are moving up on worries about their budget. But if they were to be looking at a recession and cut aggressively, I think the Fed would take a step back and say, well, is that really our problem, or is that their problem? Similar story with the rest of Europe. China is an interesting situation, because what they really should probably be doing is fiscal stimulus. Now, if they were to kick in big fiscal stimulus that were to lift economic growth globally via manufacturing, with trade with Germany and other European countries where it would really have a big impact, I think that might make the Fed pause a bit and say, oh, okay, we're some of the deflationary impact of a weak China economy is wearing off, and maybe we have to be a bit more careful. But I don't know that all the central banks need to move in lockstep in this cycle. Each has very different economic circumstances, and the U.S. has held up much better than the rest of the G10 in terms of economic growth. I think the Fed will reflect that.
Okay, so turning now to yields and fixed income, the 10-year has been rising faster than the 2 year, so the yield curve in the U.S. has been steepening. Do you expect that to continue?
Our base case is for a bit of a bull steepener, as we are expecting more Fed rate cuts ahead. We think the 10-year is kind of reasonably priced, maybe priced a little high here. We had a fair value just under 4%. And with the economy doing better, 4.25 doesn't strike me as out of bounds for a reasonable 10-year yield. So the movement in the curve we're expecting is more Fed rate cuts, bringing down the lower duration bonds. But that being said, there's likely to be a lot of volatility here. I think that there's a lot of uncertainty about how fast the Fed can move, if the Fed can move, depending on the economic data and the inflation data. So I don't think it's going to be a smooth ride.
The MOVE index, also known as the VIX for bonds, has been rising of late. What is that signaling, Kathy?
Yeah, it's partly the fast rise in rates. You typically see the volatility index spike up when rates spike up. But I think there's a tremendous amount of uncertainty. So you've got, the surprising economic data. You've got worries about what the Fed will do now after we thought we had a pretty clear path. Now we don't have a clear path. So we got a lot of uncertainty there. And we have the election coming up and uncertainty about fiscal policy ahead. So you mix that all together, and no wonder volatility is rising. We're also getting to a less liquid time of year. I think a lot of the major investors are kind of stepping back and not really wanting to be in the market in a heavy way because there's just so much that can change over the next couple of weeks.
Is it fair to say that a Fed cut cycle is not going to affect bonds from all spectrum or from the entire duration spectrum equally?
It won't affect them equally. Obviously, shorter term yields, shorter term bonds will be much more affected by Fed policy. And longer term bonds, to an extent, will reflect expectations about where the Fed is going over the next couple of years, but they're also affected by supply and demand and prospects for, and that reflects fiscal policy and prospects for inflation. So that when you get further out the yield curve to like 10-year, the big drivers are inflation, Fed policy, economic growth. Those are and inflation expectations. Those are really the big things that drive longer term yields. Short term yields much more closely driven by Fed policy.
Well, 2022 was a really bad year for bonds as well as equities. Why is it that the 10-year rose in conjunction with the Federal Reserve raising rates during that time?
Well, if you recall, we're coming off zero interest rates and a Fed policy that was still, reflecting quantitative easing, where the Fed had been purchasing bonds to hold on their balance sheet to hold down yields on long duration bonds. So then we quickly pivoted when the Fed started to raise rates. They raised them really fast, and expectations about growth and inflation shifted really, really fast, and that affected long-term rates as well. So they all it was a classic sort of, one-time upward shift in yield, something you don't see very often. And so I think that was kind of a unique case. And then we had the shift from quantitative easing to quantitative tightening. That also had some impact on long-term rates.
If the Fed were to re-engage in asset purchases, actually the M2 money supply has been going up, even though the Fed balance sheet is shrinking. If the money supply continues to go up, would that have any impact on yields?
The link between money supply and yields has not been as tight recently as it had in the past, because I think the velocity is lower, the velocity of money is lower. And so, there's structural changes in the way the bank and finance system works that makes money supply a less easy way to view forward rates. So I don't know it would depend on what would be driving the money supply growth and what that implied about future inflation.
The 10-year is currently sitting at around 4.26%. Could we see a return to 5%, which is what happened late last year?
It seems doubtful to me because inflation is significantly lower now and seems to still be trending lower. So we'd have to see, even though growth has accelerated or reaccelerated from the low levels it was a year ago. So maybe if we got an even greater acceleration or we got some sort of an inflation surprise on the upside, but it seems doubtful to me that that's going to happen. I don't think we'll get back to 5%.
Okay, so overall, are you more bullish on the longer term or shorter term duration bonds?
Well, what we're saying is stick to your benchmark. And for us, a benchmark is the aggregate bond index. It's around 6 years. And the reason is that if we continue to see rates rise, the belly of the curve, that 2 to 7 year area is going to feel it because you're not going to see the Fed rate cuts. And that's going to get affected probably more than the long end. But if we see inflation pick up, the long end gets more affected. So it depends on what's driving it. We think right now the benchmark around 6, if you're in high quality bonds, whether it's treasuries, investment grade corporate bonds, mortgage-backed securities, you get a pretty decent yield, 4.5% to 5%. without taking extended duration risk, or you don't have the reinvestment risk of staying too short, and you don't get caught in the belly of the curve too much if the Fed doesn't do what's expected. So we're kind of right down the middle.
How do you feel about corporate bonds right now? Do you think that spreads will widen going into next year?
I think it's inevitable. Spreads are going to move up at some stage of the game. They're very, very low. They've been tight for quite a while and drifting lower, but that will require some sort of slowdown in the economy. And so total return and investment grade will probably still be fine because you'd get a lower move in yields, even if spreads moved out a little bit. So we still think high quality investment grade bonds look good from a total return perspective. Not really expecting a big widening in spreads anytime soon, just because the economy is holding up pretty well. And corporate profits just hit a record high, another record high in the last quarter. So there's not a lot to indicate that there's a widening in spreads coming anytime soon.
There's been bullish calls on the US dollar a few weeks before the election. The dollar's been surging. Is that because of economic growth prospects that we talked about, or is that because of election prospects?
I think there's a combination of things going on there. Clearly, the dollar started to rebound as the economic data started to get better. So that was part of it, I think, part of it driving. And it's been in this 2-year trading range, really broad sideways range at a high level. But then you add the election issue. And are we going to see very expansive fiscal policy? We're going to see tariffs that the Fed has to react to by hiking rates. I think there may be some of that embedded in the steep rise in the dollar recently. Big question marks around it. I think it's probably unlikely to spike higher from here and stay there because it's somewhat highly valued. But there's, again, it's probably reflecting a lot of the uncertainty in the market and people trying to position themselves for surprising outcomes.
Your outlook on interest rate differentials for the US dollar, do you expect other currencies to have higher or lower growth in interest rates relative to the US?
Yeah, so far we've seen quite a wide spread between US interest rates and those in other major economies. I think it's about 200 basis point spread. If you look at the US ag versus the global ag ex US, it's around 4.6 versus 2.6. So that gives a lot of support to the dollar. And I think that will stay fairly wide. It may narrow a bit from here, but it's likely to stay pretty wide because when we look around, there's not a lot of places that aren't cutting rates and beating the US in this cycle. So Canada, Australia, et cetera, we're starting to see rates come down there fairly quickly. So I think the yield differentials will stay in favor of the dollar. They may narrow a bit, but not by much.
Okay. Just want to show you one more chart, Kathy. This is from the Wall Street Journal. Treasury yields are above the Federal Reserve interest rate forecast range. So five-year Treasury yield in the blue line and the dotted line signal the long-term Fed rate projections on the higher range and the low range. So when Treasury yields are above the Fed funds rate, is that a healthy economy?
Well, I think they're taking the estimate of the Fed funds rate from the last dot plot. Is that correct? Yeah. If they do that, then that dot plot's probably out of date already,
Okay.
right? So they'll probably move closer together the next time we get a dot plot. But yeah, I think it does reflect a healthy economy. There's some rise in the term premium, but term premium, yeah, that's one of those conceptual things that we have a difficult time pinning down exactly what's driving it at any moment in time. But yeah, I think it's a reflection of the economy doing better. Look, we're doing pretty well with 3% GDP growth with yields at these levels. That would suggest the Fed doesn't have to cut that much. The terminal rate will be higher than the had projected just at the September meeting.
Is there a natural rate of the Fed funds rate such that we don't have, we have a Goldilocks scenario of reasonably strong growth, but not too high of an inflation rate? What rate does that have to be?
Yeah, good question. It's one of those
Powell
things.
has asked that question several times. I don't think he gave a straightforward answer, but maybe you have a better answer.
I don't know what it is. It's one of those things that everybody
Yeah,
talks about, no one's ever seen, right?
sure.
It's the Sasquatch of the of the financial markets. I mean, I would think it'd be higher than it has in the past. We don't have a big overhang of debt in the private sector, which would limit economic growth. And we have a pretty big risk appetite right now amongst investors, and that should probably mean it's higher than it used to be. But finding that equilibrium rate and pinning it down is really tough question.
Okay. Finally, Kathy, do you have any thoughts on this last chart before we go here? Also from the WSJ, total return on treasuries between the last time the Federal Reserve raises rates and the last time it lowers them. So we have here 2-year, 10-year, and 30-year bonds. The historical average on the longer term duration bonds has been higher between these cycles. Any reaction to this? Does
Yeah,
that signal to you your fixed income investment prospects for the next cycle?
yeah. I don't know. Whenever you average different cycles, you
Hmm.
can kind of skew the data, but it is not unusual for bond yields to start falling prior to the first rate cut, bounce up a little bit after the first rate cut, and then subsequently decline as we get into the cycle. And that should be positive, positive returns. We're also starting with higher yield. So when you're looking at total return, it includes the income earned plus the price change. And one of the problems in 2020 is there was no yield to start with. There was no coupon income to compound. Now we have income to compound. So we should be looking at pretty healthy positive returns going forward.
Appreciate your time, Kathy. Where can we learn more from you and Charles Schwab?
Well, you can go to schwab.com/learn. And you can learn tab, this drop down menu, and everything under fixed income or bonds that we put out will be there, along with videos. Or on social media. You can find us in a lot of places.
Okay, we'll put some of the links down below. So take a look there. Thank you very much again, Kathy. We'll speak again soon.
Thank you, David.
And thank you for watching. Don't forget to like and subscribe.